In 2023, the most important thing to be watching is the Federal Reserve. And of course, central bankers around the world are pushing up and down liquidity, really creating a yo-yo in markets. Today, we take a look at stocks, commodities, and cryptos to further understand the movements that have happened over the last week and why there could be some incredibly interesting reports coming into this week's inflation reading. Let's get into it right now together. See you soon. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We've got some amazing macro news and of course the hottest key levels coming up your way throughout today's show in the special weekend edition. If it's your first time here, welcome, subscribe and smash that like button if you find value in today's video, which I'm sure you will. So the Fed is about to find out whether it can actually pause rates. We'll take a look at the expectations that the market has a little bit later on, but we know it's inflation week. This is the biggest read of 2022 now into 2023. What happened on Friday's report? Well, it was another really hot report, but I'll say this about these jobs numbers. Yes, we saw 253,000 jobs created. We'll take a look at that in a minute. Obviously, unemployment remains very firm down in those 3.4s, and we're not seeing the signs of recession coming through yet, which may mean the Fed has to do more work. But I think what's really interesting here is take a look at these revisions. In February, the number has now been revised down by 78,000. We've also seen the March revised down by 71,000. What is even the point of these numbers? 149,000 lower than previously reported. It is almost ridiculous. Here are where the change in the non-farm payroll numbers came through. You can see it's really focused into a couple of sectors of the market, and some have been healthier, some have been worse. Wholesale trade out of interest was the one that actually went down through that period. If we then move over to the change in non-farms and look at all of the previous changes, yes, we've seen a pretty steady decline over time, but of course January and even this statistic are really showing that the Federal Reserve may have to pause for longer or even the chance of another hike. Yes, that's starting to come in as a small statistical chance, but really it's pausing for longer that we want to be looking at moving forward when we're talking about stocks. Little wonder why we got that rally through the end of last week. Of course, we saw bearish action, which we suspected would happen at the top. Then we came to the whole regional banking crisis. So this whole regional banking crisis is causing the Federal Reserve to do some sneaky action in the back, which we'll look at soon. But with so many people going bearish, with specials being run, usually that means there's further upside potential. Look at this switch in charts in terms of the survey. Yes, it's just one data point, but 44.9% of people were bearish in the middle of last week, only 24% bullish and 31% neutral. That's a huge bear read up from where it has been. And we know we use that as a bit of a counter-intuitive kind of technique there with the surveys. Here's one of our charts tracking a little bit about central bank kind of policies. And while they say something on the surface, like we're going to be tapering, we're going to do something like that, once we started to see this whole central bank intervention in the back end, we had a suspicion that this demand would be reached and then, of course, blown up through it. KRE in particular is quite oversold, and that caused a bit of a squeeze through the Friday session, which we reported over on our Twitter. So central bank liquidity is coming back in, even though they're claiming they're tapering. This is to support these banks. It could continue to go up, and if it does, we have to expect new highs here in the market and into what we call extreme zone 2. We'll take a look at that a little bit later on, but this is just an update here on central bank policy and thought process. What about smart money versus dumb money inflows? Well, we've seen a little bit more smart money action down on these lows, especially the demand area. Dumb money's obviously getting scared again. That's us, unfortunately, usually the retail trader. And it makes sense. The regional banking crisis has caused a few stirs in the media, which we'll look at in a second. But before all of that, let's look at the forward curves. So this is the kind of expectations that the market has compared to the Fed. Remember, the Fed looks like this. They're basically saying no cuts to 2024. And this is the most important case for bears right now. The market believes that the Federal Reserve will begin cutting as soon as most likely somewhere in August to September of this year. They're going to basically cut fairly quickly. September pretty much hallmarked as the first cut. A pause generally is left for a while to see how the policy is dealing with the economy. If they instantly cut it like the market expects, well, that's why so many market participants are in the tech stocks. They're the ones that do really well off central bank injection liquidity and, of course, rate cuts as well. But this is a very interesting chart. The difference between the dot plot, which I'm assuming we're going to see very, very soon come out from the Federal Reserve, and the expectation of the market. Here's another little interesting chart just about credit card balances. Obviously, we've reported on this. The American consumer, which is 1/3 of the US economy, is starting to get a little bit sick. Why? Well, they're spending outside of their means. And you can see this with credit card balances. And of course, you can see it now with the beginning of outstanding overdue amounts starting to increase again. It's not at critical yet, but I think this could blow out of proportions fairly quickly throughout the middle to, of course, the back half, specifically into Q3 of this year. And it's something that we will be tracking here on the channel. So make sure you subscribe if you're interested in that type of stuff. So what about when the main media gets hold of stories and start playing the bear game? Well, unfortunately, when CNBC Markets in Turmoil specials run, it actually has a 100% track record with being a 1 year forward total return positive indicator. This could be very interesting to what we see happening in the markets, which could look like this and then that later on. But yeah, it's being run right now. As of the 5th of May, we see a stat here and you can see all of the reports in the past. Maybe it's one of the best stats we've ever seen. Retail investors have shoved money into cash. Is this usually a positive thing? We know that the biggest money has gone to cash, but they're really going to money markets in general. Now, is it statistically the best time to be in cash? Well, in some ways, yes, in some ways, no. The stats behind retail money asset changes, though, other than them being correct in the GFC, have not been so positive. If you actually take a look here, 100% of the time, 1 month and 3 months later, markets have generally gone to the positive side. Now, this doesn't mean that it will happen again, but you can see the stats here when retail run to cash. We do want to be pointing out from an investor standpoint, that's a very big difference to a cash standpoint, because basically from an investor's point of view, you're wanting cheap price, and cheap price usually can be seen in the worlds of forward PE. So we're really backing in the concept of it depends what central banks do here. If central banks stick to their word and force a pause and hold, then we have to expect basically equity risk premium to come down, and that should force forward PE ratios back underneath their averages of 16.8. If you're an investor, this is one of the reasons you might want to purchase underneath. If you purchase down here, you're getting effectively a cheap long-term rate. If you purchase up here as an investor, well, it's a totally different story. Trader won't really care so much about this chart, but investors certainly will. Let's look and go over a couple of other things that we want to be talking about, which is really that the economy is starting to falter from the point of view of the Federal Reserve. If you're a bear in the market, it's been better to go for demand destruction plays than anything else. And I've said here for a while on the channel that my demand destruction plays are generally in the metals field and, of course, the oil field as well. I usually go for these commodities kind of aspects because really if demand is faltering, what's hit first? It's these ones. We've seen some 1 month low surges in energy stocks. We've also seen what the stats show, which is not good over the next 3 to 6 months. And this is where those real bear stats play out. Remember, it's not just being right, it's about being the selection of the asset. If you're trying to short big tech stocks right now, it's been brutal. If you're trying to short metals, well, it's actually been pretty good. Now, let's have a look here at the S&P 500 energy after we get these readings. We got this last week, and you can see again the next couple of months usually statistically down overall, and we've seen that across a lot of the commodity space. Below 35% read, which we got only a week ago, the annualized returns of commodities trends across the board are negative 15.8%. This only happens 11% of the time, so it's a pretty rare statistic, and it just again shows you the difference. When we move over to some other interesting facts, I thought I'd bring up here some money flows. This is literally what the biggest players are doing on a chart. I know it doesn't look that exciting on the surface, but this one here is for gold. So recently we've seen upticks in gold. And you might think, well, is it real or is it false? Well, the big players have been buying gold, and you can see the latest update basically just says a stagnation. They're purchasing at the same rate as they have been. Now, this is not an extremely high purchase rate. It's kind of in the middling ground, but If this starts to drop down, which I'll be the first to report on here on the channel, then you know that the distribution, let's say if we are in distribution on gold, which we'll talk about, will be a false thing, and we can actually look towards putting that together with our technical analysis and strengthening the case. What about for the stock market, you might ask? Well, we've got that one as well. You can see here that money managers are neutralized, basically around this 500, 600,000 net positive. They're always buying. I mean, that's always the case here because there's always inflows coming in. But when you look at this, 600,000 is basically the middling ground. It's not ultra bullish yet, but it's certainly not bearish. And there's actually a new higher high being formed over the last 2 weeks in terms of money inflows. Now, this is a mixture of pension funds and a mixture of hedge funds and a mixture of just really large players. So we're off their lows, which we saw over here. We're still rallying, and basically we haven't actually seen any decline on this. If we do start to see a decline though, especially in the next 100 points on the S&P or even around here, this will be very good for swing traders. So swing traders will particularly want this one along with investors, and it's very powerful for them. Not great for day traders, but certainly good for the other two. What about leveraged fund players? Well, leveraged funds have actually down their leverage over the last week. You can see here they've been almost the highest amount of shorts on record, and this is a pretty big play. Generally speaking, they're not that wrong, at least with the short-term view. Day traders can use this concept, but I generally find it still better for swing. We're not on a new low yet. I'd be very interested to see the new reads on this one to see whether we can make a new low in terms of shorts, but we do need to remember that they were heavily short into August of 2022, and we all know how that played out. They were correct. So if the market keeps pushing up higher and they keep increasing their shorts, they generally will turn the market around, at least for an initial period, and we'll talk about that later on when we look at the charts. Let's move over to the earnings releases this week. We're back through the biggest part now. So effectively, we've gone through the gauntlet of big tech. They reported okay, I guess, with low earnings expectations. They have also now gone to a very high forward PE. So it's not like big tech is cheap. In fact, the top 10 or 5 to 10 stocks in the market have accounted for like 85% plus of everything in the stock market this year in terms of gains. So it is not a healthy market underneath, but that will also provide opportunity should you be actually, let's say, wrong on your medium-term bearish bias. You'll be able to get into those rotational plays when it comes out. It might not be sexy like an Apple or anything like that, but it's certainly there. Earnings release this week, you can see the options market, huge moves here expected for Lucid, Roblox, PLTR, which is the favorite of some people. And then, of course, we've got Disney coming after the close on Wednesday, and that's expected to be pretty high for Disney, around 6 to 7% average moves. So some interesting stocks to look at. We might focus in on something like Disney later on this week, so stick around for that. Let's look at rotational plays. What's going on in the rotational world? Well, it was a relatively defensive, strange kind of stack over the last 5 days. Staples, healthcare, and utilities were in the top 5. We had gold, obviously, with its breakout doing well. Gold stocks in particular held pretty well. And then we had technology just holding up. In the flip side, we had energy, metals, and of course, the regional banks getting destroyed. But regional banks, I believe, were squeezed hard. In fact, 97% of all outstanding shares were overshorted, according to the Bloomberg stats that we saw. So that was pretty exceptional. On the Friday trade, the squeeze came through. I posted this is most likely the case over on Twitter. So make sure to follow at FX Evolution if you're interested over on the Twitters. And it was not a defensive day on the Fridays. Look at this: gold, utilities, healthcare, and staples. The top 4 defensive sectors were not running. So everything was being run by effectively all of the big tech stocks. And we need to just realize that that could be a bullish increment here, even going into a bear zone that we'll look at later. And we'll explain why it's possible that this happens based on the S&P 500's creation very, very soon. So just before we jump into the charts and we take a look at all of the key levels you should be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, if you've been watching the channel for a while, you'd know I love Microsoft stock. It's my favorite stock because of basically the high moat and, of course, the almost monopoly it has in the sector. At the moment, if you fund with as little as 1 cent from the Australian audience or upwards of 1,500, you'll gain an additional bonus on top of the already existing free fractional shares that you get when you sign up. But why do I like the Tiger Brokers platform? Well, here's just a little snippet of one of the things I really like about it. And that comes down to being able to customize your platform and for your needs. Now, a lot of you out there love options. You want news. And of course, you want things like volume profiles. Well, you can get that. You can get clocks. You can get refreshing news. And of course, you can also see some very important information about IV, percentiles, PC ratios, and everything else within it. You can actually additionally add any of these blocks if you want to by just clicking the button up here in the toolbox and then creating your own custom screener. So this is one of the reasons I like Tiger Brokers. There's plenty of others out there, especially in earnings season. And if you're interested in checking out their platform, you can look in the links in the description down below and check out the special offers that may be applicable to you and your country. Thanks so much. Let's get into it. All right, well, let's get into the charts and let's get started here with the RSP. This is the S&P 500 equal weighted portfolio. Basically, it shows you without the top 10 tech stocks this year has been bad. Frankly, it hasn't been very good. So RSP is certainly looking totally different to the rest of the markets. We actually got a new low on RSP. We almost filled into that gap. You can see it went wick to wick and then it's come back up. But I think notably, we have a lot of island reversals across the markets. Gap down, gap up. Is this a trap for bears where bears may have tried to short in here? Yeah, I do think it could be based on that central bank liquidity chart that we're looking at soon. Let's have a look here at XLY versus XLP. We didn't see too much move. This is American consumer. Basically, it's been sick during this rally, which is not usual for a proper bull market rally, but we'll keep going and talking about it as we can. What about copper? This is showing us whether the markets are really ready to probably fall off a cliff. Copper held its zone. 3.82, still very strong. No weekly close below. We're looking for this to get dumped into 3.7. Underneath 3.7, very bad for the Australian viewers. If you're in the XJO, that would not be what you want to see. But overall, this is a very important level. And I think copper remains one of my most watched charts of 2023. US versus 2-year versus 10-year. This shows us inversion. Now, we're not seeing, well, we want to see this actually go down and underneath 1. You might say, why would you want that? You've never really seen a US recession without the yield actually inverting. So if you're a bear, you kind of want it reinvert, like as in go past and get rid of the inversion. And then that usually actually brings the pain train. At the moment, still very inverted. We'll see what the inflation reports bring us though. That will probably game change that particular yield spread. US 2 versus US 10, very important. We saw, of course, 2-year and 10-year both up. 2-year was up 3.27% on the Friday trade, thanks to the non-farm payrolls numbers. So what about HYG? This is, of course, high yield junk bonds. Well, high yield junk bonds came out of the gate pretty strong. They held up through the session in comparison to both TLT and corporates, LQD. So it shows you that maybe the rally is partially real. I mean, unless high yields are coming down as well, we usually look for that one to be a good read with the stock market. So it helps us to kind of say, well, maybe there is a bit of buyers coming back in here at the demand zone. Treasuries didn't do too badly, didn't do too well. It just keeps holding this zone. Still very boring. US 10-year needs to fall through the ground. And of course, the Federal Reserve needs to do a lot of cutting for treasuries to do well. Well, we haven't seen that just yet. What about the US dollar? Frankly, it looks bad. And US dollar has been stuck in this range for quite a while. We had an outside candle, which is a higher high and a lower low from the previous one. You can see here the weekly closed down. The US dollar came under further pressure. And you would think that rallies keep getting met by sell demand based on just the weekly alone. The areas I'm looking for are underneath parity. I wouldn't trust this 100 level very much. I think 99, 98, 63 is very possible for the dollar. If we go to the daily, again, just nothing here looks very positive. And that's the problem. You know, we've gone back to things like the weekly levels. We've trapped it and we've basically seen a short. And I just don't like what I see here on the US dollar. there is a possibility it's still accumulation, but we're just not seeing it. It came through, broke above here and went down. The currencies themselves have been much better to trade than actually reading the dollar itself. As we suspected, gold did find a floor. So gold broke to the upside. Everyone got super hyperactive on it. It dumped pretty damn hard. I mean, that wasn't just a significant dump. That was pretty big. And it came back down. It closed up. It found a little bit of wick purchasing. I said this for a while. This is the heavily traded zone. I was pretty neutral in gold last week. I am obviously midterm feeling a little bit dodgy on gold. This is not usually a strong time of the year for it. And gold's been running. I understand why. But if the Fed kind of sticks to their plan and says, hey, we're staying higher for longer, it's going to be tough for gold. Gold loves cuts of yield as well. So it didn't do well with the non-farm payrolls number. It absolutely hated that number and it went down hard. I wouldn't be surprised at all for us to return back to the most traded zone at 1983, but I'm not sure if there's a significant trade in here at this stage. We basically went, here's a bit of a structured demand. We snapped that very hard. We've created that higher high. We've broken down and then we've come back. The only thing I can think of at this stage is maybe a retracement to one of the fibs, a 61.8 style fib back into here, or if we take that high there again, just into that range. So I think pullbacks up here, there could be sellers that commit around this daily level, and this is going to be where I think the buyers sit. I'd say gold very neutral coming to this week, but that's very different from gold stocks. You'll notice gold stocks actually closed at a new high. So gold stocks are still very behind gold. Basically, we can see where gold stocks have been in the past during gold's highs. They're actually still underpriced to the potential of where they should be. So gold stocks, a little bit different. Obviously, go into the daily. They actually ended up rallying through the session. And it's a totally different story. And I just wanted to bring that up so you could see it. What about US oil? Well, oil has bounced off the low. I was hoping it would come back to a 61.8 fib to allow buyers to get back in. And I suspect oil may have a little bit more run in it back up into this most traded zone between this support here and this resistance, creating a very nice supply zone. I do think there'll be an okay trade on gold. I do think it'll come up. I'd like to see it there. There is a little block in here, so it's found its first level of resistance. So if resistance is going to be, it's going to sit around there. We'll move the fib up now because we've got that range. So it's very possible it does something like this. I also like the idea of it just going into here, creating a structure and then coming back down. And probably that's the one I favor if I was looking. But I can see why this would be an important zone. There's a lot of trapped price in there. And that's probably, for a lot of people, they won't be able to see that one. So yeah, it's at a resistance. If it breaks higher, I would suspect it comes into here. But I think the key is to have patience and react to the market in this situation on oil. It's not that easy with the way it's fallen off. Speaking about oil or energy stocks, obviously I'm negative on these at the moment. I have been up here. And the way I'm looking at it at this stage is to effectively probably see a bit more of a relief rally in oil, and then I'd like to see it further fall off. And that's consistent with some of the things we've shown on the charts recently. Like a lot of the market, there's a lot of gap downs, builds and gaps up. Now that's what they call an island reversal, and generally they hold some momentum in them, and there's a little bit of that going on across the markets at this stage. A lot of island reversals. They're actually a decent pattern. They're a bit better than standard percentages, like they're better than 50-50s, but of course it's all playing the stats when you're talking about this game. Tesla, how did it come out? Well, let's have a look at the 2 hour just so you can see. So it actually came out of the gates bullish, and this is something we've talked about. We've created a bit of a gap down, and then we were looking for a gap up. I would have liked it to make it easier to like open like that, so it was more clear that it was a gap up, but it gapped up and it closed at 170. You've got to suspect it might go towards these options weekly highs and that 180 gap fill, or possibly even 185. So I'm going to draw a box there this week. It does look like Tesla wants to make a bit of a run for it on the upside. It doesn't really change my long-term opinion at 145 and for us to go and get that one. But on the surface of it, let's look at the facts. The facts are we closed on near the high, which is fairly bullish. We came out with a gap, which is fairly bullish, which usually means pullback should be met by buy demand. And when we look at the S&P 500 later, there's some interesting parts of that chart as well that'll be there. But yeah, look, there's a huge range in here. We know that there's a lot to fill. We know where the expected weekly options highs are. And when Tesla gets a little bit of a run on it, if people feel bullish, all of a sudden it can spike out pretty hard. Let's move over to some other individual stocks before we go into indices. First up's Nvidia. And you can see here, Nvidia's come into the highs. And this is a watch reaction level that we had. The weekly did not even close to hold down, 4% up on the session. And Nvidia is just blown back up into this zone. So yeah, okay, I'm pretty bearish on the pair here. I still think Nvidia is getting a little bit carried away with itself with this run, but I would have preferred the weekly obviously went and closed low to then confirm that this was what we call a distribution. This was most likely UT or UTAD breakout, false break, all of that type of good stuff. If Nvidia does break this level, my suspicion is it goes a little bit higher and actually goes into these blocks at 300. So you might even see it run 300 plus. And yeah, it's hard to stop a freight train in comparison. Remember, one thing I always say to people that I mentor is you're better off actually not attacking a really strong chart like this. You're always better. I know everyone's hot on it and they want to kill it and put it down. However, the thing is that if you went and shorted, like again, a metal or energy recently, there've been better shorts. Or of course, you could have shorted regional banks until they went 97% short squeezed. But yeah, that's the type of thing. You want to short bad stuff, bad companies. That's usually the easier way. Trying to short even like a stock like Apple here is very, very difficult. Is it in the range? Well, Jim Cramer has given his kiss of death to the Apple, so it must be getting close. We've seen, of course, the earnings report. It was better, but really, I mean, it was barely better. So everybody loves the Apple report, supposedly, and we've seen this big gap up. This market is now in the range that I expected it to get to for bears to take some control. In here, I'm going to be looking day trading kind of concepts. I want to see whether it takes these highs. I want to see reactions in here. So this is like a watch reaction here kind of concept. But from a pure squeeze perspective, you have absolutely no reason yet to actually say this thing is bearish. At least you got something on Nvidia. We don't have that yet here. Both expected weekly options lows and highs are here. And it's starting to get a little bit extended, but you know, Apple, it can do this and it can run some pretty big stops as well because it's so traded by retail traders. On the Friday video before Thursday night kind of video before Friday, we reported on the concept here of regional banks and the fact that they were extended down into an incredibly big demand zone. Well, yeah, once we found out that we also had 97% or something like that of covered shorts over the stock, and a lot of it was synthetics, that's created a squeeze. Everybody was attacking the regional banks. Look, do I like them? Not really. Do I think that they've been given some support by the Fed? Well, yes. And you can also see here that this is another one of those gap down, gap ups. So many gap down, gap ups, island reversals across the board in the markets. And I mean, they're like everywhere. So is there more to come? I would say that probably something like KRE, while it's hit that support becomes resistance concept, I wouldn't be surprised at all for it to push a little bit higher. If you missed it, don't worry about it. There's other ones. But what this is a pure capitulation. And this is outside of every boundary, and it's very common. Generally speaking, with capitulation plays, the way to play them, or the way to concept it, is it comes down first and everyone has buy the dip mentalities. It's the secondary drop that happens, and I'll just tell you this, the second drop is the one you actually want to be looking at with capitulation plays. There are a lot of smart people I know that play these types of things. Risk management is key, and of course, selection of your instrument, like an option or something, is very, very important. What about the DAX? Well, if we have a look at the weekly close, hard pressed to go against that right now, but you know where the bears have control. My goodness, imagine if you were able to close below those lows, it'd be on, and we will be watching on the DAX, but it still looks like it's strong. The Australian market is much weaker. The XJO finishing the week down. You'd have to expect it to be up though on the session through the Monday, and we're basically going back into this 7.3 kind of level. You would think maybe the bears are found there to push it back down. Again, copper will be the one to watch, energy stocks, all of those types of things, but XJO will come out fairly strong on the Monday session, and we'll reassess from there. Let's move into the American market. IWM gets its support from the Fed. That central bank nasty back end door lies that they put through true. It's very strong. 170 holds again. Bears cannot take a break here. There's no break under 170, and yeah, that doesn't allow IWM through. Let's look at the Russell 2000 from the futures perspective. You can again see how it is. Long leg doji, close above. We had this as our short zone last week. It was a beautiful trade. There's still a lot of trade in here. I'm just wondering if we get up there, what happens? Like, I think with the Russell, you got to be a little bit careful this week. It was a glorious trade last week. I don't have the same conviction on it this week. I really don't want to do anything on this pair at this stage. I would like to see whether it breaks this high or, of course, how we see this float out. Like, I mean, if we get a high past here, then theoretically pullback should be looked at as buys, and then this could be considered a Wyckoff bottom. What I'm getting at though here is that if you look at this on a weekly, the opportunity is totally different to other markets. From the peak to the trough, and this is why you should never have FOMO, there's always another opportunity. We're still down 28%. From the peak to the actual bottom, as I say here, this is 33%. So we're still down 28 of 33 total. If you compare that to the S&P in a few seconds, you'll see that, yes, it's gone back 50, whereas the Qs are totally different. So there's always another opportunity to be a bull. It's just going to be in sectors generally that you don't like to trade. From the bear perspective, hey, they've been the markets to attack. Russell has been a horror show this year. Totally different market to the Qs here that we see. What about the weekly close? We'll know where the bears win. If the bears push under here, oh yeah, it should be on for the swing traders. But at this stage, again, big bullish close, hard pressed to go against the concept of the markets getting back up into these 330s if we continue to see pullbacks met by rallies. Let's have a look at the NASDAQ. Here's the NASDAQ in the highs. Could this be still a UTAD breakout? Yes, it could. It could do this, pull down. A lot of this is going to be, for a swing trader anyway, patience and reaction. I think patience and reaction is going to play very hot here. And we know that these levels are still open for the NASDAQ. We also know if this false breaks, see that the fact that the actual high is almost identical. If that false breaks and then rejects, it will have trapped the last buy liquidity. So bears, I wouldn't be too scared. There's still very good opportunities moving forward over these next couple of months. But of course, we do see, we have to look at the reality, and the reality is that we're seeing some pretty big squeezes, and that damn central bank liquidity's come back in pretty hard. Here's the SPY. Here are the expected weekly options highs and lows. You can see the bottom end, island reversal, gap down, huge squeeze on KRE, which also came with all these unwinds of probably all those hedges that we talked about last week. And it was just a absolute manipulation fest. The market's come back up to a bit of resistance, but I think the important thing here is when we have a look here at ES futures, you might notice that it also came back down to our VWAP level. So VWAP was hit. There was a lot of reasons to like that zone, as we discussed. Now the question becomes, are we able to short right in here? There's a little potential little short here. 42.20 also a key level for day traders. But if we get through that, of course, back to the 4300s, and I think people will lose their minds if it gets up there. But that's, of course, when you want to have the most strong conviction of, if you see turns on the TA charts, you'll be ready and, smashing it all the way. Let's have a look at the SPX here again. Here's the flow. Here's the island reversal, which is generally a bullish signal or a bearish signal, depending on how it shows. But it's showing like that. It's kind of showing you pullbacks would be met by buy demands. And we'll look at the futures market now. So let's actually load up the S&P 500 futures to get a bit of an idea of what happened here. So first up, we made a new low. I think that's important to state. Generally speaking, the way you would look at this market, generally speaking, is you would say high, low, higher high, lower low, pull back, and bears should defend in here. So I said a zone of bears in here. This is the most heavily traded zone throughout this entire range. We know it's critical for bears to hold this. We know that if the bulls regain control too much, they're going to pressure the upside. So basically, it's now for the bears. The bears have to fight this zone. And if they get higher, let's say we get this unfilled gap, all of a sudden we've got a high, kind of low, or low, high, lower, low, and then we've got a higher high, which is pointing towards pullbacks being met by buy demand, including that island reversal, including what we've got on the sentiment survey, including so many things. So it's a very pivotal point here leading into inflation numbers. And I think there's going to be some great day trades this week. So stick around for us. I think it's going to be pretty good. I've also put in the trend line here. You can see they snapped that trend line, but it was respected a little bit in the charts. We did report on, of course, this being a bullish turn over the Thursday session. And now that's taken this high, I think that the most likely scenarios are maybe a little bit of weakness coming into, well, this is just my thought process. Chess playing is always the way I like to look at markets. Come up with 4 or 5 different scenarios for your day trades or your swings. When you see that scenario, because you've played it out and you've played out what the stats should look like in the back end, then you'll be able to, more clearly think about it at that time. I think that's a big game changer for a lot of people. Have a lot of scenarios and then have the patience to react to those scenarios. So first up could be the market comes down, breaches this low, rallies back up a little bit, then sells off back into something around this 40-80 zone. Now, if we get back into there, I'd expect buyers to try to recommit, at least initially. So that's the first scenario. The second scenario is that the markets keep driving higher. Now, if they drive higher and they go back to the unfilled zone gap of 41.67, I still expect a sell, but that sell to most likely be ripped at that point. And then that rip to effectively go to a new high. We'll keep updating at that point. Above 42.17 remains 4,300 to 4,350 is incoming. So a lot of people are going to be asking, Tom, you are so bearish on the midterm. Has all this changed your mind? Not really. It hasn't changed my mind at all. Of course, you do need to be a realist, and the realism is that the Federal Reserve must hold true to what they've been claiming. Of course, what we've seen over the last week is, again, them failing to live up to that expectation of effectively, not coming in with the big bazookas to protect the regional banking crisis. So what you're really hoping on, if you're a bear here, and just give you the real truth, this is the way as I see it, is they have to stick to their dot plot. Pause for longer. I'd be surprised. And I don't think they're going to cut as fast as everyone else expects them to. This is where I differ from a lot of people in the market. But I've talked to some pretty smart people. It's obviously their opinions as well, and a collective combined opinion that they believe central banks around the world will be forced to pause for longer than their bonds expect them to. So I think that's the good midterm scenario for the bears, and something that you have to keep in mind. If you agree or disagree, that's fine. I mean, this is the market's the beautiful thing, but that's where we're at right now. So we still think that this could be a very interesting point, and I think it's a kind of like a pivotal area. If markets actually manage to, let's say another scenario just quickly, if markets were able to breach back below this and snap that island reversal, I mean, what they've done. I mean, at that point, it actually becomes clear that the bears are in full control of the market. They've trapped everybody and they're ready to go. But I don't think that's the scenario the most likely at this stage. Let's have a look at the options for the week ahead. This is into the 12th expiration. There are a lot of calls on the market starting to appear, so that's an interesting point here. More calls than puts. Max pain sits around 409, so not really any surprises there. We'll just quickly refresh this, make sure we're up to date on it. I think it's a little bit off. So let's refresh this just a little bit. There we go, 409, yeah, still. So you can see the calls coming through at the 422, 416. This may hold the market down. Obviously, the inflation read will change the game. That is a very important read because all of a sudden the Fed's getting questioned. What about Bitcoin? Well, Bitcoin's been a little bit more simple, actually. Bitcoin's been easier. We reported on this being a short zone in this box. So we short, this is where we were on the report. Came down, no new low, came up, shorted the zone. Cool, really good. It's moved down, new low formed. Okay, so then we can grab in some information. I think around this 29.3 will really dictate the bears. We know it's a heavily traded zone. I think if markets are able to get back up here, I wouldn't be surprised at all to see shorters get in. For some time, actually now, about 2 weeks, Bitcoin's been some of the best trading we've seen on the market. One of the guys in our community managed to pull out a 20, I think it was like 25 or 27 to 1 trade out of Bitcoin. That's pretty damn good. That's a great ratio, and congrats to him. But yeah, it's been pretty nice. Let's move over to the news ahead. We know we got inflation on Wednesday. Ooh, Ooh, big numbers, big numbers. This is very important. 8:30 a.m. New York time, so obviously 1 hour before the market opens. Then we have PPI, big numbers, and then we get prelim UOM consumer sentiment on Friday. So a lot of huge data for the Fed. The markets will be moving hard. Make sure to subscribe to the channel if you enjoyed what you saw. Follow us on Twitter and other socials. And of course, if you're interested as well, you can get a couple of free trading cheat sheets by just clicking the links in the description down below. Also a reminder, the sponsor of today's video, which is Tiger Brokers. If you're from Australia in particular, take advantage if you're interested of the special offers. And of course, what you need to do is meet the requirements. So check them out. Also for everyone else, if you're interested in the platform, check them out. Links in the description down below. Thanks so much. Have a great weekend. Bye for now.